We think we know most, if not everything, that we need to know about gold. Investors do their research and marketers spin their best yarns. Support is offered with an amazing array of fundamental and technical factors on display for all to see. But what are we not seeing? The normalcy bias is a phenomenon of disbelieving one situation when faced with grave and imminent danger and/or catastrophe. A more complete definition states the normalcy bias or normality bias refers to a mental state people enter when facing a disaster. It causes people to underestimate both the possibility of a disaster occurring and its possible effects. This often results in situations where people fail to adequately prepare for a disaster. The assumption that is made in the case of the normalcy bias is that since a disaster never has occurred, then it never will occur. It also results in the inability of people to cope with a disaster once it occurs. People with a normalcy bias have difficulties reacting to something they have not experienced before, and they tend to interpret the warnings in the most optimistic way possible, seizing on any ambiguities to infer a less serious situation. Investors and others plan for the future based on what they know or are used to. On a day-to-day basis, most of us think and act according to what has happened most recently, and usually with a positive bias. That's reasonable and expected. The problem is that when something bigger and hugely negative shows itself, we tend to ignore it or explain it away. There is historical precedent for that. The best example from the past is the Great Depression. The warning signs were there. A decline in economic activity that started before the stock market crash. Trouble in Europe and other parts of the world. A sense of fear and anxiety associated with the stock market, and especially when significant drops occurred. Regardless, investors acted as though everything were fine, or simply ignored the indicators. They were encouraged to buy stocks using borrowed money, and they did so with reckless abandon. Confident in the proclamations of experts that everything would be fine, they marched towards the big D, seemingly unaware of the gravity of the situation they faced and totally unprepared. Recently, investors in cryptocurrencies were blindsided by a series of events that seemed unimaginable to them a year ago. Again, it was more a case of ignoring the warnings or seeing them in the most optimistic way possible. The US dollar price of Bitcoin has dropped nearly 80% in barely more than 1 year. Today, gold investors are acting very much as if the normalcy bias is in effect. Independent of unrealistic expectations for higher prices, they cannot seem to accept the possibility that gold prices can decline in large measure and for long periods of time. They underestimate the possibility of a disaster occurring and are unprepared for it. It is quite possible for the gold price to drop much further and for the decline to last much longer. The size of the drop and the length of the decline could be much, much worse than imagined.